Good morning, everybody. This is Don Pren with InsMark. In our ongoing series of sales ideas using InsMark software with Chris Jacob, today I think you're going to really like the program. Today we're focused on how to use CHEIFS home equity funding for A credits, mass affluent, high net worth, ultra high net worth, to use the CHEIFS home equity funding for an older client and show how that home equity funding would be used in an immediate annuity and sort of comparing, as you always do with Wealthy and Wise, sort of the status quo versus this CHEIFS home equity funding and immediate annuity. What does that do in terms of not only the amount of income available to your clients during retirement, but also predictable income and peace of mind, which I think are equally important. So today we have a number of people, primarily Chris Jacob, will be doing the presentation. We've also got the two co-founders of Cornerstone, which they are the developers of the CHEIFS home equity product, Craig Korn and Dan Anderson. Bob Strauss, also one of the co-founders of Repredict, which is a great product, helps you with case design and making everything faster and more efficient using AI in terms of running source proposals for InsMark. And so you're going to love today's program. This is our 7th episode in our series of sales ideas. We're going to continue to do these about once a month. With that, Chris, take it away.
Just going to make sure that you all can see my screen. I'm gonna start with the end and the beginning, okay, and show you how we're going to arrive at this. We've got a couple that desires 120,000 of income adjusted for inflation, and we're going to compare under status quo versus this CHEIFS plus a single premium immediate annuity. What difference will that make to them in their liquid net worth over time? And as you can see, here's joint life expectancy, same cash flow, but significantly more liquid assets available to them by freeing up a dormant asset, if you will. And if you just look at it graphically, that is a joint life expectancy. Same income, but about, you know, a substantial more in terms of liquid. But I think this one is the most telling. If somebody makes it to 100, hey, you got the same income, but you're better off by $1.6 million in liquid assets. Where would you rather be, right? And then I also went in and did the following. How much more could they afford to spend, not run out of money by incorporating CHEIFS plus a single premium immediate annuity? And survey says $135,000. Notice this runs out of money here. They don't over here. They still have liquid assets left. So in that case, it looks like, let's see, get my mouse going. This.
Great. Yeah, and Chris,
Income.
Chris, just stop for just a second and let's let everybody kind of absorb this. So let me make sure I'm understanding here. So strategy one is status quo. Client just keeps going the way they're going without a change. In that scenario, it produces 4.1 million of after-tax income from age 76 to age 95 or 96. And they're out of liquidity. All their liquidity is gone by age 96. Strategy two, we produce almost 4.9 million of after-tax income instead of 4.1 million, and they still have $335,000 of liquidity remaining at age 100. Do I have it right?
Is this a great country or what? Yeah.
Okay.
You do.
So we need to understand strategy two, because that's a lot better than the status quo strategy one.
Not, by the way, just to let you folks know what I'm going to show you here, you're going to get the PDFs that were presented. You're also going to get this client workbook so that you could kind of use this as a template to build off of. I'll show you how to do that. But under status quo, all we did was say, look, these folks have a few assets. They've got 1.1 million in a non-qualified account. They've got 1.2 million in IRA assets. They have a paid for home worth $1.5 million. All right. They want $120,000 of net after tax income coming in adjusted for inflation, I think I used 2%. So they need assets that can deliver $4.3 million of after-tax cash flow. I'll blow that up a little for you. Where's it going to come from? Well, the only reliable source, and that might be debatable, is Social Security. It's going to come to them. And I didn't inflate it because Medicare and all that stuff typically eats up the COLA, cost of living. So here's what they need. Here's where it's coming. And we'll break this down. Here's the Social Security, of course. And they're already at the RMD stage, required minimum distribution stage on their IRA assets. So they're just going to take what they need for RMDs and they're going to augment that with brokerage account distributions to generate this desired income. Now, notice they're just taking RMDs all the way down the line, but this brokerage account is going to run out. They're going to have to take more. So let's look at that. Here's the brokerage account. It's a million one with a cost basis of 800. Rainbows and unicorns is growing at 7% without ever having a down year. And we're taking into account capital gains tax. So they're pre-tax selling this in order to net what they need to couple with the Social Security income and this 1.2 million also getting 7%. We're saying they're a 35% bracket. So they have to take this. This is what they wind up with after tax. So if you look at this for a moment, I'm going to go backwards. 32,911, 51,809, 32,911, 51,809, plus the 36 gives them the 120. All right. InsMark's the only way I know that you could possibly solve for this and actually.
Okay, so Chris, this is the status quo where this is the first graph you showed, where both plans are trying to meet the 120,000 a year need with inflation.
Right.
So this is the status quo on that, where they're able to meet it, but they have almost no liquidity at the end. Go ahead.
Well, they have 170 grand at the end.
All right.
All right. So
Yep.
yeah, you know, they made it by that much. Uh,
Okay.
and then the house we got growing at 2%. And in this scenario, they're not accessing any of the proceeds of the house. So
And Chris, what income tax rate are we using?
we are showing them at 35%.
All right. And that can be whatever you want,
Yeah,
but thank you.
combined federal and state.
All right, fine.
So the house has grown at 2. So when you look at their total net worth, it is the house at 2%. The net after tax of the qualified plan money plus the brokerage account gives you net worth. If they both die while there's still retirement plan monies left, there's going to be tax on that. So the tail of the tape on net to heirs is what you see here. Okay. This is where it's going to get interesting. So I cloned that to come up with what I'll call CHEIFS plus SPIA. And let's look at what is different in here that's going to give them a whole lot more liquidity than status quo. So they still want this $120,000. But in this case, we are going to fund a single premium immediate annuity for 325,000. That's going to be derived, as you'll see here in a second, by the CHEIFS transaction. Okay. So let me get there first. We have $1.5 million here. In the previous scenario, I did not have this box checked. When I check this box, I go into edit details. Remember, this is a home. There's no loan on it. This will figure out for you, and this is where Don, you and Craig might want to come in on exactly how this works, because this is very unique compared to a HELOC and a reverse mortgage.
Yeah, so what's going on here is we've integrated the CHEIFS home equity product into Wealthy and Wise. And what's happening here is by knowing the value of their home, the Wealthy and Wise module will automatically calculate the maximum CHEIFS advance that's available with this particular home. And in this case, it's $326,437. We calculate that automatically because we have the CHEIFS formulas inside Wealthy and Wise. And then the way it works is that the repayment to Cornerstone does not need to be made until the home is sold. So no payments, nothing until the home is sold, similar to how a reverse mortgage works, although this is not a mortgage and it's not debt. It's an advance sale structurally. And the return to Cornerstone on the three, in this case, $325,000 advance is the lesser of a 12.99% interest rate, or, and this is the key point, 50% of the future value of the home. And so what you find, if we go out, say, 20 years, these people are in their forever home, you'll see that the cost of funds declines from that 12.99% all the way down to 6.33%. Why? Because it's the lesser of column 3 and column 4. So column 3, again, is limited to 50% of the value of the home. What you're going to find with reverse mortgages, which are going to be in the 8.5, 9, 10% long-term cost of funds, is instead of giving back half of the value of the home to Cornerstone, with a reverse mortgage, the client and client's estate would need to give back the entire home to the reverse mortgage lender or shared appreciation contract lender. So that's why we were very, very interested in the CHEIFS product, because for people in their forever home, all of the features of not having payments, not paying back the advance until such time as the home is sold, likely at the death of the client or when the client is needing to move from the home to nursing home care or assisted living, largely an estate transaction, you're looking at a cost of funds, 5, 6, 7% that is very attractive under that structure. And if you can then create liquidity from that home equity that can then be redeployed into things like immediate annuities, all of a sudden you have a very, very big improvement in your clients' access to income, their long-term liquidity, and their peace of mind. So, Chris, go ahead.
All right. Okay. By the way, the house doesn't have to be paid for. Okay. It can have a loan against it. And Craig, what is about the ratio that it still works as a chief transaction?
We typically, yeah, Chris, we typically tell advisors and their homeowner clients that if they've got a mortgage that is less than, call it 35% of the value of their property, 35% LTV, so to say, that's probably the right level for considering a chief. If they've got a significant mortgage on their house, it's probably not useful to consider a chief. And Chris, it's useful for people to know that roughly 41% of all homeowners have no mortgage,
Yep.
and another 15 to 25% have a very small mortgage, like sort of in the chief's radar zone. So the market opportunity out there is clearly vast.
Yeah, I just plugged in a $200,000 loan on this, and my max Chiefs went from 326 to 238. It
That's
still
exactly.
works.
That's
Okay. So to keep things
I think it'd
consistent.
be, Craig, good time, based on what you just said, to talk about the ideal client profile. Go ahead.
Don, you're exactly. So Cornerstone has been doing this now for roughly 7, 8 months. We fund millions of dollars a month of Chiefs transactions with advisors who work on Wealthy and Wise Plus and others around the country. And the typical client that we've seen so far probably looks a lot like the client that you all do business with. They're a 58-year-old. They're in a $2 million house. They've got a really good credit score, typically 740 to 750, although credit is not important when it comes to a Chiefs transaction. Neither is income, for what it's worth. A third of the time, they have no mortgage on their house. Two-thirds, kind of like the way Chris just described it, they have a small mortgage on their house. And typically, they take out $250,000 on a Chief transaction and sell a small fraction of their home. They use that money, that $250,000, almost exclusively to make investment decisions, to purchase insurance, and more recently, Don and Chris, as you two know, to pay the taxes on Roth conversions.
Yep.
Yeah, there's a whole bunch of different things that your clients can use liquidity for that sort of um, comes from a source they didn't think they had. In this case, home equity. Obviously, using it for investments, annuities, you can use it to fund Roth taxes, lifestyle, whatever is helpful to the client. And that's what's so great about Wealthy Wise is you can show so easily the before and after. I do want to take a second and talk about who's not a good candidate for Chiefs. And what I would say about that is you really need people that have at least a 10 to 15 year or longer plan to be in the home. So, if you're dealing with very ill clients that have a short life expectancy, that wouldn't be a good fit. If you're dealing with clients that are like, oh no, our home, we live in Northern California, but all our kids are in Hawaii. And in the next 5 years, we're going to sell this house and move to Hawaii. Not a good fit. As you can see in column 6, the short-term cost of funds is going to be similar to a reverse mortgage. And really the best place to get short-term funds from home equity is a HELOC, but you got to pay the money back. And what Chris is going to show you right now is, as you can see on the screen, there's a place where you can go in and put in assumptions on a HELOC and a reverse mortgage, which he's showing the reverse mortgage costs here. And then let's go to the graph, Chris, and show there's a really nifty graph that you can, on just at a glance, kind of see where Chiefs is really applicable. Let's go to the next page. There we go. So, all right, what you're going to see here is for a HELOC, the problem with HELOCs, and they're more competitive than reverse mortgages, especially in the short term. Look at those early years, how the HELOC is the best option. The problem with HELOCs is that, first of all, there's a period, typically 10 years with most banks, which is your draw period, where you have to make interest-only payments. Let's call that 10 years. That's very typical. Then the second tier, 10 years, is the repayment period, which is they stop the line and then you've got to make payments of principal and interest, typically over a 30-year amortization structure. So that gets you to the next 10 years. And then at the end of those 10 years, there's a balloon payment for whatever the remaining balance is. So yeah, it's great for a 5 or 10 year need, but you've got to make payments and you got to pay the money back. It's really apples and chairs compared to either reverse mortgages or Chiefs, where you have no payments and you don't have to make any payments back until the home is ultimately sold. So if you're really wanting to do apples and apples, it's the purple line versus the Chiefs brown line. And as you can see, reverse mortgages, and this is why your mass affluent and high net worth clients are not doing reverse mortgages, because they don't accept those costs shown in the purple line. It's just too expensive. If you're not desperate for liquidity, it's like, I'm not going to pay all these fees and all this money to the bank. I don't want to reduce my estate, even though I can, have it paid all the way at the end of my life. I just can't swallow all these costs and fees. That's why Chiefs is so attractive, because over the medium to long term, if you look at the brown line, that is a cost of funds structure that your mass affluent and high net worth clients are going to accept, especially if you can show that home equity funding from Chiefs deployed in something that improves their life during retirement, in this case, the immediate annuity. Craig, anything to add?
I think you hit the nail on the head, Don.
I do have a question, Craig. I know the answer, but I want you to answer it. Like with the HELOC, what do you got to be 62 or older to get it? I think. What's the age restriction on Chiefs?
So we've done Chiefs on people who are 25 years old. We've done Chiefs on people in their 80s. HELOCs are in a lot of ways like Chiefs. You can do them when you're younger, you can do them when you're older. Reverse mortgages typically have a 62 and older age requirement. And it goes without saying, reverse mortgages typically have, in fact, almost always have a requirement to pay off your existing mortgage. And Don, as you and I like to say, if you've got a client who's got a 30-year fixed rate mortgage at 2.75%, they should not be in the business of paying off that mortgage if they can afford it. That's the greatest liability they'll ever have.
Well, and how many people refinance their mortgages and have a $2 million home with a $300,000 or $400,000 mortgage at 3%? a giant number of people that are not desperate for liquidity. Those people are never going to do a reverse mortgage, never in a million years, because they don't want to be forced to pay off that 3% mortgage. Whereas with CHEIFS, it can layer on top. Now, a great point, Craig. One other thing I want to, another place where CHEIFS is not appropriate, if you have a client that is desperate for liquidity, they are out of liquidity, they are in trouble. That's a client that should seriously consider either a reverse mortgage, or if they can qualify for a HELOC, or even selling the home. CHEIFS is not the option there. CHEIFS is not for people who don't care what it costs. I need as much liquidity as I can possibly get. That's the sort of reverse mortgage share and appreciation contract world. Where CHEIFS makes sense is for people who aren't desperate for liquidity, but would like more liquidity if the costs were appropriate. They're not gonna stand for the reverse mortgage costs. They're not gonna stand for shared appreciation contracts. It's just too expensive. They're not that desperate for liquidity. But if someone was, CHEIFS is probably not the product for them.
So now that we've checked the box for CHIEFS and we've indicated, I just use a round number of 325, in addition to my desired cash flow that's spendable that I want, which is this 120 adjusted for inflation at 3%, I also want to have dedicated cash flow for funding the SPIA. Where's it going to come from? Well, once you check that box, okay, for CHIEFS, it's going to bring in, you're not seeing it here, but it's automatically going to bring it in the system. So we still got the Social Security, right? This, you may not know, and I got to tell you folks, I've been using this system since 1987, and there's one button I didn't even know existed until I worked on this. In the drop-down box, one of the, pre-populated options is single premium immediate annuity. You hit it, you go to schedule. Now, in the past, what I would do is I would go to an IMO, FMO, BGA. Here's the data on my clients. Here's how much you're going to put in. Produce a single premium immediate annuity for me. Give me the best one. It turns out you don't have to do that. Okay. And where did these figures come from? See where it says single premium immediate annuity? Hidden in the left corner here that I never did know is you can click that button and it will take you to a website where you can enter the information. And when you do, you will get back something that looks like this. Okay. So, and you can do it life only, joint survivor, period certain. Well, I chose that one, that 2276. Okay. And what I did here, hang on just a second. There we go. So what I did is I put in that 2276 here, I put in their ages, and this is something that I don't know that any other software program will do for you. It calculates of that income in that year, what part of it is a tax-free return of capital and what part of it is taxable, what's the tax on that, and what's the net after tax. You can see there's a point down the road where they've received all of their capital back and 100% of this is taxable. Okay. So it automatically fills this in for you once you go there. So just remember, single premium immediate annuity, hit that drop down box, hit that, go here, hit that, get your quote, plug in the numbers, you're good to go. Okay.
Yeah, and Chris, here's what I would say about that. There's probably other software programs out there that calculate the single premium immediate annuity taxation, and maybe there's some that will give you the quotes. I don't think anybody's not only figuring out the quote, then also figuring out the taxation, the exclusion ratios, and then integrating that in a financial planning scenario, showing the net after tax from the immediate annuity in the context of an overall financial plan to show you the impact versus doing nothing. That I think is pretty special.
Yeah, you're exactly right. So everything being the same, other than, what is our job as financial advisors? Find the money and do it painlessly so that, they're cash flow neutral from their perspective. They're not having to come out of pocket for life insurance, long-term care, single premium immediate annuity. And now that we've got both of those scenarios in, so status quo, CHIEFS plus SPIA, let's do what InsMark does best. and let's do comparison. Do it versus don't do it. And that's where we get into this comparison down here. And if I hit preview, what you're going to see is the following. So some of you may not know that since Chiefs has been incorporated, there is a new comparison that you can do. It used to be that you could only do this versus net worth, which would include the home. But now you can do spendable cash flow versus liquid assets, which is extremely beneficial when incorporating Chiefs because that's the real juice for the squeeze. Look, in 10 years, same income, but you got $400,000 more here with Chiefs, right? You know, look at this. And look at this. So what I typically do for my graphs, I pick to illustrate the differential at joint life expectancy and the differential if somebody makes it to 100. So see these numbers here? We go here, and that is the differential at joint life expectancy. Same income, more liquid. And if I advance one more, same income, 1,600,000 more liquid. Where would you rather be?
Yeah, and I would also mention, Chris, or I would mention to the client that having the single premium immediate annuity is even better than what you're showing because if you live to your 150 years old, that income keeps coming in.
Mhm.
So they did a study about happiness during retirement. It wasn't whether you were married, it wasn't whether you were healthy. Those were on the list. The number one factor was reliable, predictable source of income. And what they found was people that had retired from teachers, unions, and other types of defined benefit plans that had predictable income forever, no matter how long they lived, didn't make any difference. They knew that check was coming in the mail, even if it wasn't a big check. They were significantly happier. It was the number one determinant on significant happier retirement than people that had just pension defined 401ks where they kind of were responsible for how much to put in and where would I would invest it and how much can I take out. And so knowing that, integrating a single premium immediate annuity that has that element of no matter how long you live, that check keeps coming, it is a big deal in terms of peace of mind for clients. So yes, the numbers make tons of sense. There's also a psychological component that is a huge advantage.
And let me show you, just in case you're not aware, when you're building this comparison and you go in and hit your report selections over here, see these now that say liquid assets, okay? These were never there before. Now they are. And I didn't want to put you guys in the Migo stage. My eyes glaze over, so I only included this out of the range of all these. Right?
Right. Yeah, cool.
Anyway, yeah, before the only thing that we were able to do was do a comparison to net worth, which wasn't liquid assets. And now we can do this spendable cash flow. What's my differential in liquid net worth? And what's my differential in wealth to heirs? You can see heirs also wind up better out of this thing down the road. Okay. All right. That's one. And the other one that I did is I just said, okay, if we incorporate Chiefs, I just did a solve for how much income could be produced without running out of money. And it's this right here. So you're showing, look, if you're still going to maintain the same 120, down the road, you're going to have $1 million, 1,600,000 more in liquid net worth. But if you do want to spend more, what do we talk about? Go-go years, slow-go years, and no-go years. If they're still in their go-go years, maybe they want to do a little bit more in the way of traveling. Okay. So notice cash flow required. I'm going to say 135, and we need $325,000 to fund the SPIA. Where's it going to come from? Well, when you click that box in the liabilities next to home and Chiefs, and that amount comes in, it automatically brings that into expected cash flow. And it automatically brings in the net after tax annual income from the SPIA. And of course, you still got the same Social Security. So when you go to the cash flow page, by the way, this is kind of neat. It also includes and shows you how the net after tax was derived from that SPIA, taking into account the return of capital, the part that was taxable, giving you this. So you can validate those numbers right there for your fact find follow through people. So what we need and what's provided are equal. You don't run out of money. Okay. As you'll see, remember the brokerage account ran out before. We still got money left in the brokerage account. And remember down here, we we were taking greater than required minimum distributions right here. We only do that at age 100 now, and we still have money left. So I can get more money and still have liquid assets left at age 100. So when you do the comparison of the do it versus don't do it there, which is this one, the red means they ran out of money. All right. And now look at the differentials in liquid, even though they're still getting income here, they're $400,000 better off in liquid. And here, they're another $880,000 better off. So graphically represented, this is life expectancy, same income, 880,000 more of liquid. And we looked at this at the beginning of the show, $800,000 more in spendable income while still having 335 of liquid and having run out of liquid assets right here. A picture's worth 1,000 words. That's what I love about InsMark. You've got the people who are, hey, those graphs are great, but show me the spreadsheet numbers where they came from. And we can validate those graphs. And then you got other people who just say, show me plan one versus plan two. I'm good with just visuals, right? So you got the best of both worlds. This will also do it for you in 3D graphs. I just happen to like 2D graphs. So, that's up to you.
Yeah. So thank you, Craig. Thank you, Chris. Am I interrupting you, Chris? I just had a
No,
quick.
I mean, that's I've pretty much given you the full Monty right now. And I will
Okay. Thank you.
folks this. I want to show you one thing. When you
Go ahead.
bring in this workbook, what I would recommend doing is you bring in this workbook and then you go here and hit open, and it's going to be on this. You should clone it, make a copy of it. Okay. Now you can play in the sandbox with this one, put in your own figures, change ages and stuff, and have this as your, you know, base workbook that you can generate new ones off of. Not saying you're going to mess it up, but if you do here, you just don't want to mess this one up and save it in a wrong way. Better to clone it and then work off the clone.
And
So,
so I want everybody to know, everyone who's listening today, you'll all get an email later this week with a recording of the webinar as well as the workbook files that Chris is referencing. So you have those. Also, for any of you who do not have Wealthy and Wise, it's normally a couple $1,000s and $60 a month. For a limited time, we're waiving the $2,000 upfront fee. So if you don't have Wealthy and Wise and you have ever thought about getting it, you should get it now before we bring the $2,000 upfront fee back. Also, we integrated Wealthy and Wise and Wealthy and Wise Advance. Now there's just one product, Wealthy and Wise Plus, that also includes all of the Cornerstone integrations. Again, we're waiving the $2,000 fee for limited time, and it's $60 a month. In addition, and last thing I'll say about this, but this is a total no-brainer in terms of value and cost. The other thing we'll be releasing, if we haven't already released it, but it's any day, is something called the Client Data Questionnaire, which is you have to have Wealthy and Wise to get access to that. But what it will do is allow you to digitally play a game of table tennis with your clients through email to get all the information you need on their assets, liabilities when they want to retire, to be able to do the Wealthy and Wise analysis. So just the client data questionnaire alone is worth the $60 a month in terms of the ability to more easily interface with your clients on getting their information, so you can then do a financial analysis with Wealthy and Wise and make decisions in the context of how it affects things short, medium, and long term, rather than just making a financial recommendation in isolation. So a lot of great things happening with our Wealthy and Wise for our Wealthy and Wise customers. Normally at this time, I would move to questions and answers, which I will do. But before I move to that, Craig, Dan, Bob, Chris, does anybody have anything else before we move to questions and answers?
Well, I did want to say something. If you go to the InsMark website, if this is your first time seeing CHEIFS being incorporated into InsMark, if you go to training videos and webinars, there's an archive of other recorded sessions that incorporated of CHEIFS. Okay. So this is what Don was talking about, using CHEIFS to fund the tax on a Roth conversion. Very interesting here. So you can just click the button and hit watch. The one other thing we didn't get into here, really don't have time, but if you look in InsMark, some of you probably say, I understand this CHEIFS button. What's this repredict button thing? Okay. Now, if you go into, I'm not going to click it because I already have an account, but I think this is worthwhile just to take a look at it and possibly set up a demo. It's actually patented AI assisted software, and Don said it in the beginning, but we asked if we could have, where's my, uh, there we go. Let's see, right here, in his own words, powerful artificial intelligence platform, increasing efficiency and effectiveness for producers. What used to take 15 to 30 minutes per change now only takes 15 to 30 seconds. I'm not going to show it to you, but bottom line, you can import an illustration. You can change the premium, you can change the income without having to go back to the illustration software, and then you can export that new change directly into InsMark.
Yeah, and that's true for virtually any financial product. So you could bring over any type of life insurance product, any type of annuity into repredict. You bring over the case for your client, male age 55, whatever it is, and then you instantly can change anything on the board, and it automatically through AI understands the actuarial underpinning and makes every other change. It literally is a magic wizard for case design in terms of efficiency and functionality, which you may not have with your carrier software or
Right. Well, I mean, let's face it,
Flex, whatever.
I think there's 40 relationships with InsMark that have the InsMark button file that you can
Yeah.
transfer it to. But a lot of those carriers limit what modules you can use. They even limit the color format on some of them, which I don't understand.
True.
So here, have you ever been in this conundrum before? You're working with some carrier, you got the PDF of the illustration, you want to get the data into InsMark. How do you do it? Well, you try to copy and paste. Oh, that won't work. They got it locked out. You try to transfer it into a PDF to Excel, and it gets all jumbled up because there's subtotals and there's verbiage on there. Here, one of the things you can do is you can import an illustration in probably under 15 seconds, and then export the entire thing directly to InsMark, no matter what carrier, whether it's IUL, VUL, whole life. So I said I wasn't going to say a lot about this, but I did say a lot about this. I think the best thing to do is just go to repredict.com and then schedule demo. With the genius behind this is my partner, Bob Strauss. He's absolutely amazing. Every day he says, refresh your screen. Watch what I just changed last night.
Hey, Chris, question. The audience is inquiring about what carrier did you use in your example?
Uh, for the
The
SPIA,
Yeah.
Yeah.
this one right here. I just went in, clicked that button in InsMark, input the information. said, I want a joint and 100% survivor income with 10 years guaranteed. And it will flip out 5 different pages of life only with refund, with cash refund. And so the answer is that Equitrust. I just went with the highest one.
Okay,
That was
great.
it.
So also,
And
guys, I just want to jump in. Don, you mentioned a couple of
please.
things that you said where chiefs may not be appropriate. We are
Yeah.
seeing some traction in those individuals that have a suppressed life expectancy that require in-home health care. They're actually selling a fraction of their home in a laddered environment to fulfill that financial obligation, which is more efficient than selling investment portfolio, which has capital gains and more often than not, state income tax ramifications. So we're seeing a lot of that compare and contrast of home equity reposition versus downsizing your AUM portfolio. So that's number one. Number two, there was a lot of questions and comments on
But
suitability.
Dan, I
Yes.
want to stay on number one because I think you're right. I think I'm wrong, but I want to stand up for just a minute. Chris, can you bring up the graph? You're making a great point. Can you bring up the graph that shows the reverse mortgage HELOC and Chiefs transaction? I want to bring that graph up again because I think Dan's making a great point. Yes, yes.
Okay.
And let's look at the graph. There we go. And go to page 2, which is a quick preview is fine. And then
So
go to
as,
second
as
page.
you're doing that, let me just comment on what's the process. First of all, there's no financial
Yeah.
underwriting. We underwrite the home equity. So the process is very simple. We get an electronic application, and it's a very soft application. We do up appraisal. After the appraisal is completed, we agree on the valuation. We do title work, and we fund. Last month, we funded a transaction in 10 business days. So this is fast and furious, and also our investor is soon to approve some appraisal opportunities, electronic appraisal opportunities that will dramatically reduce the timeline for appraisals.
So Chris, can you go back to that graph?
Yep, I will. Boom. Back to the graph right here.
Thank you. So I think what you're saying is the purple line, which is reverse mortgages in the first couple of years, is higher than the brown line. That's what you're saying.
Well, yes, the Chiefs proceeds cost to the consumer 12.99%.
Yeah.
On a highly appreciative AUM portfolio, it's much greater to liquidate. What's the cost to liquidate securities that have been, highly appreciative environment for the last 5, 10 years versus selling a
High.
percentage of your home? It's high. Yeah. I just
And
want to address
your
one other
point is
question.
your point is you don't use a reverse mortgage because in the first 2, 3, 4 years, reverse mortgages, as we can see, are prohibitively expensive.
That's right.
Exactly. The costs associated with the reverse are exorbitant. The age restrictions, you can't have a first mortgage with a reverse. It needs to be a debt-free. It has to be paid.
Right. Great
There's a
point.
lot of stuff. But I
Thank
just want
you.
to address one other commentary that was flying around regarding suitability and carrier approval. Audience, this is a current asset. This is no different than selling your Exxon stock to fund that Equitrust annuity. This is no different than downsizing from $1 million home to a $500,000 home to free up a $500,000 to fund that annuity. So there's a FINRA regulation out there called 0489. 0489 clearly addresses that an investment professional should not introduce a debt instrument for the purpose of investing. This is not a debt instrument. So there's no 0489 ramifications, and therefore it's not premium finance, it's not a home equity line of credit, it's a current asset. So to answer the question suitability on an annuity application or a life insurance application, it's current asset. That's it. And we've heard that loud and clear from the insurance carrier audience. Craig and I literally have spent 2 years on this journey presenting to reinsurers, carriers, regulators, and we've heard a resounding, this is a current asset. There's no need. It's not premium finance. It's not a HELOC. It's not a reverse. It is a non-debt instrument. It's a forward sale of an individual's home or a forward sale of a current asset. That's simple. Sorry, Don.
No, it's perfect. Dan and Craig, can you also address 2 items? Number one, the Chiefs proceeds are not currently taxable from a capital gain standpoint. And secondly, which I think you just covered, but if you can just touch on it again, there's the concern that what about the regulatory prohibitions on using home equity to fund annuities, to fund life insurance, and so on? Go ahead.
Craig, you want to take that
Yeah,
one?
so let me answer a bunch of things that I've been trying to follow through the chat as best as I can, but they're fast and furious, which is always good. Um, so first and foremost, Cornerstone and InsMark for that matter have absolutely no involvement in what you do with the chief proceeds. The homeowner ultimately decides what they want to do with the money. As your advisor, you're advising them on what to do with the money. And if that means you want to pick the Equitrust annuity or some other annuity or use any carrier that you choose to work with, it's up to you. We have absolutely no involvement with the carrier, product selection, any of that. That's between you and your client. So that's the first thing. Second thing is, Dan, you were asking about um, suitability,
Or
carriers,
taxation, is it taxable?
taxation.
Yep.
So when someone takes out a mortgage, when someone takes out a reverse mortgage, when someone takes out a Chiefs, those proceeds that, Chris, I don't know what it was, like $238,000 or $236,000, that money is not taxable at the time that you receive it. So let's just start and end with that. Your ultimate tax situation when you sell your house is literally impossible to predict. We don't know your cost basis. We don't know what your house will sell for. You may have a capital gain. You may not have a capital gain. You may be exempt from capital gains depending on whether you're a single or a married couple. Like there's a lot of variables there.
Well, step up in
Well,
basis if you die.
Mhm.
all those things done weigh into it. And of course, we in InsMark are not in the business of giving tax advice. But what we can say is you're putting an obligation against your house that you do have to pay at some point in the future. That has the impact of reducing the total amount of proceeds that you get and therefore reducing your capital gain. That's the expectation. But we have no idea what the outcome will be because we don't know what's going to happen in the future with respect to your ultimate sale price.
And Don and Tony, team with InsMark, Sasheen and Julie, this is a wonderful thing, I think. So if you guys could put a link or put this as a PDF on what you're going to send out, it's 6 pages long, not too voluminous, but it really goes through in full detail to show you how this works.
Tony, when we send the email to everybody on the call right now, all the attendees, can you make sure to include this PDF document to everybody?
Yes, sir.
Thank you.
So you guys are going to get these PDFs from me, which are the full Monty on do it versus don't do it, on 120, on 130, and then we'll send the SPIA page and we'll send you the InsMark workbook. Okay.
Mhm. So this
Yeah, and Chris, can you do one more thing?
Sure.
I want to show, it was really cool. Go to insmark.com and show where the webinars are again, all the past ones.
Okay.
And Chris, while you're doing that, let me just address some of these questions. The minimum.
Yeah, well, wait, Dan,
Okay.
I'm only going to be 2 seconds.
Got
Okay,
it.
everybody look at this. When you go down to recorded webinars, you see where it says download training material next to the watch. For any of our past webinars, if you click on download training material, you can get access to the workbook files that were used in any of those webinars. Go ahead, Dan.
Great, thank you. Minimum Chiefs transaction. We publish 70,000. We have some flexibility, especially for this audience and especially with our partnership with InsMark. That's number one. Number two, farmland. Difficult to do farms at this time. They're difficult to appraise. But stay tuned. We're constantly innovating and changing the underwriting box. And again, my contact information is danderson@Chiefs, and we spell Chiefs the proper way. We're not the Kansas City Chiefs. It's CHEIFS, and the acronym is Converting Home Equity into Financial Success. So again, D. Anderson, ON@Chiefs.com, and C. Corn, just like corn on the cob, @Chiefs.com. We're happy to do a one-off. We're happy to run through a number of scenarios. We're happy to do a one-on-one demonstration with InsMark, specifically Wealthy and Wise. It's very important. So we're happy to help.
Yep.
Dan,
All
I'm
right.
looking at some of these other questions here.
Me too. Go ahead.
Minimum home value. We've done deals on homes less than 300,000. That's fine. We just don't see them all that often on more mass affluent type of customers. They tend to have much higher home values.
Keep going, Craig, on the questions. Keep going.
I'm looking here. What
What,
else
did we
do we
cover
have
everything?
here? What else here?
So what is the website for Cornerstone? It's cornerstonefinancing.com is the corporate website, or simply chiefs.com, CHEIFS.com.
Yeah, that's the one I use. Simple.
Chiefs cash.
Don, it looks like we've answered most of the questions, if not all of them, but
I agree. I'm reading them as fast as I can too. I think we've covered everything. Let me just look one more minute. So I guess what I would say is if you have follow-up questions, you can contact Chiefs directly. Cornerstone has a Chiefs product. You can also contact Julie in the area at InsMark if you need to get wealthy wires, if you have wealthy wires, you need help.
So it's funny,
I'm
Don,
going to
there's a couple questions
yes,
I saw
please.
regarding,
Good.
individuals using. So first of all, a seller can repay Chiefs off at any time. We say and state there's no term, but there is a term, and the term is 150 years of age. We had to come up with a term, so we chose 150 years of age. Have we seen transactions where cash buyers will save AUM, meaning they will come out of pocket 80% for $1 million transaction, and Chiefs will put in $200,000. Therefore, you own $1 million home. We have seen that. Have we seen individuals use Chiefs to buy a second home? Yes, we have. So diversification. If you've got a $2 million home and you want to buy another home for $500,000, do a Chief. Obviously, we're going to own a percentage of your primary. Use those proceeds to buy your second home. We'll also participate in that second home on acquisition. You now have a diversified portfolio of real estate. You own two homes now debt-free. So there's all types of applications for Chiefs, and we're happy to walk you through these applications on a one-on-one basis.
Suzanne Phillips had a good question. She said, you said several times, she's referring to me, that the right fit client is if they're in their forever home. And Dan already adjusted that and corrected me, which I'm glad he did. And then she continues, is there anything to prohibit a client from doing a Chiefs while younger, selling the home, paying off the Chiefs, and then buying another home and doing another Chiefs? Craig or Dan?
the answer
No.
is no. She can do that multiple times on multiple different owner-occupied properties. We've actually had, Dan, I think you remember this. We had one client who has 3 homes that he uses for family vacations, and he did a chief on all 3.
Well, another example, we had a client, a 24-year-old out in California. Unfortunately, her father passed away. It was a beach house worth $5 million. She did not want to part from that $5 million home that she inherited, did not have the cash flow to pay the taxes and insurance. She did a chief to the tune of $1 million to fulfill that obligation for paying taxes, maintenance, and homeowners so she can stay in that home. Also, there's some pretty interesting estate planning opportunities. Those homes that are in trust today, I mean, it's a natural to do achieve, push those proceeds back to that trust, use those proceeds to buy a big fat life insurance policy without any gift tax. And that death benefit, obviously, more often than not, is much greater than the chief's extraction or the chief's payoff. So, again, all these opportunities can be modeled within Wealthy and Wise. It's powerful. And again, this is also a really interesting in-force financing tool. So those individuals that have an in-force policy and they're scrambling, they don't want to liquidate AUM because the market, tanked in the last 2 weeks at 15, 16%, you can sell 3% of your home. Next year, you can sell another 3% of your home to fulfill that in-force premium obligation.
One
Dan,
thing, go ahead,
I'm
Craig.
sorry, Gon, go on.
I was just going to say, if you could help Chris find, because Chiefs is only available in about half of the states right now, can you go to the part on the website to show which states it's currently available? Help Chris for where he needs to go. No, on the Chiefs.com website.
Yeah.
There you
Chief,
go.
Chris, if you go into I was going to say the icon in the upper right-hand corner,
That
you should see license. If you click that, you should see licensing somewhere.
There
Licensing
it is.
info.
Licensing info.
There you
Good.
go.
Yeah.
Okay.
And this is a little outdated. We've also just recently got Indiana, there, Indiana's there. Idaho is online as of now as well. and we think Wyoming will be next. The worst question that can be asked of us, Dan, is when will Texas come on board?
I know, believe
I
me.
announced it early.
So Charles, anything you can do to go to Austin and have a conversation with the Texas legislators around why they will not consider home equity instrument products like CHEIFS, we would support you all day long. Texas is just a very strange state when it comes to home financing, and
Yeah.
we don't see CHEIFS coming on board for a while. Um, Here's a question. Virginia. Yes, we're in Virginia. Um, in the first few years, why is Chiefs interest higher than HELOC? Well, a couple reasons. I think, Don, you mentioned this before. The way Chiefs works is the cost to the consumer is going to be higher, maximum 12.99% for the first 6, 7, 8 years. It's not intended to be a shorter term transaction, although, Dan, for the reasons you outlined before, it certainly can be. Whereas HELOCs have a lower cost, but remember, you're making a payment. So ask yourself the following question. Would you rather have a cost of financing be 8% where you make a payment, or the cost of financing be 10% or 11% where you make no payments? And that's really a discussion that you almost have to have personally, which is, do I value not having cash flow payments, or do I prefer a lower cost and make payments? That's really the challenge when it's all said and done. Don, I think you said it very well before. If you look out 10 plus years, there's really nothing more cost effective than Chiefs, even relative to HELOCs.
Craig, let me expand on that HELOC that you just
Guys, I have to jump to another meeting. Okay.
Thank you, Chris.
All right.
Thanks.
Thank you.
Yeah,
Bye.
just to expand on that HELOC, that payment is after tax proceeds. So we did not, or InsMark and Wealthy and Wise did not tax affect in the analysis the tax bracket for that client for the after-tax loan payment obligation. There's no payments with Chiefs, zero. So it's a highly efficient means of reconverting a dormant asset class to active. It's the first time ever in a non-debt environment an investment professional can suggest converting a dormant asset to an active asset opportunity. And Chris Jacob, thank you so much. I know he's gone.
Yeah, I think we covered everything, at least as far as I can tell, in the questions and answers. Agreement from Craig and Dan. Do you guys agree?
I think so. I see one more question from looks like Nitin. Consequence of reduction in real estate valuation. There
Great
is a
question.
consequence. Cornerstone ends up getting less money potentially in the event home prices go down. As Don showed before, we're entitled to some percentage of the home value at the time of sale. If home prices are up, we get more. If home prices are down, we get less. But
Yeah,
we
and I
are
used
always capped at
50%.
12.99%.
I used 50% in my example, but I think it's an important point you're making. You can structure a Chiefs to be different than 50%, but it is set up at the beginning and doesn't change. It's not like it floats to whatever you guys want.
That's
It's
right.
structured with the homeowner at the time of the advance and then set. Is that right?
That's
Yeah.
correct.
Okay, good. Okay. Well, thanks everybody for joining us today. We hope this has been valuable, and look out for the next webinar in this series that will be next month, where we'll be covering Chiefs funding long-term care liabilities and how that can help your client avoid a financial nightmare where they don't have any long-term care insurance for that potential, and without wasting the money on long-term care insurance in the event that the need never arises. So with that, have a great week, everybody, and we'll see you next time.
Great. Thank you, guys.
Don, thanks again. Thanks, everybody.